You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Wednesday, Education Wednesday. Yes, it is time once again for Options Bootcamp, the premier options educational program. My name, of course, Mark Longo from the THE optionsinsider.com, as well as from the network upon which so many of you are mainlining these days. Hope you're having a great trading week out there. Remember, if you're just listening to Bootcamp, man, are you missing out? Nearly a dozen other programs waiting for you over there on the old networks. Maybe you like crypto. We have the crypto rundown. Maybe you like volatility. We have volatility views. Maybe, of course, you like a little bit more what's trading, unusual activity. We have, of course, the option block. A little bit going on with the advisors and education, asset managers. Also touch on crypto there as well, which is interesting. We have the advisors option, futures options, this week in futures options. You name it, there's probably a show here on the network that touches on that aspect of the options market in some capacity. So wherever you're getting Options Bootcamp, and it's available just about everywhere under the sun these days, make sure you're upgrading to the full network. Of course, if you like what you hear, this show or anything else we do, throw a like, a star, a comment. We've been doing this show for, man, over a decade, Dan and I. The whole network this January, 17 years. It's crazy. Crazy to say that out loud. So we've been doing it for a while. We have a lot of great reviews going back decades, but hey, the algorithms like the new stuff. They tend to favor that new stuff. So if you like what you hear, throw a like, a star, a comment, just like this week's 5-star review comes from Solo King. I like that handle. He says, thanks so much for this show and for everything you do. You've made me a better trader. Well, thank you for that. Thanks for taking the time, Solo King and everyone else out there, to rate and review. We do love. Glad to see you're enjoying the show and getting a lot of value of it. That's why we do it here at the end of the day. Of course, if you want even more in your lives, only one place to go, theoptionsinsider.com/pro. You get even more unusual activity, a whole show of it called Options Oddities. You, of course, also get a little fun show we call Pro Q&A. Just had Scott Nations in that yesterday, tackling all of your great options and volatility and you name it questions, as well as live streams. You can heckle Dan live here on the show and every other show that we do here on the network live. And, of course, great giveaways like the Pro Trading Crate. Got to give that away for the month of January now, so stay tuned for that. All sorts of fun. theoptionsinsider.com/pro. The place to go for all that. As we go around the horn, see who's joining us on the old Options Bootcamp program today. First, let's go out to the Southern Options Mecca known as Frankfurt. We are joined once again by the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to Options Bootcamp. How are you doing on this Education Wednesday, sir?
Hey, Mark, how are you? It's good to be back. And yeah, we got a lot hailing from the southern headquarters here, the Mecca.
Oh, so you're saying I wasn't just joking. It truly is the Southern Options Mecca, because we are also joined today on the program by a first-timer on Options Bootcamp and indeed on the network. She is Jenny Andrews. She is the other half of the Liz and Jenny show. We had Liz on the show back in November 15th, I do believe. So now we have the other half, Jenny Andrews, joining us here for the first time. Jenny, welcome to the Options Bootcamp program and indeed to the Options Insider Radio Network.
Thank you so much, Mark and Dan, for having me. This is, I'm actually thrilled to be here because it's like a blast from the past because I spent many years with Dan in the same pit down on the trading floor.
I'm sorry for you. Well, you mentioned your trading background. Like we said, this is your first time joining us on the network. So give our listeners a little bit of an overview of your background in the world of options. What pits, what products did you trade? And then what it is that you do over there at Tasty.
Okay, so I have a degree in economics, but I decided to go into trading instead. I was down at the CBOE for about 7 or 8 years until I had my first child. And I spent most of that time in the Bristol Myers BP crowd with Dan. But back then it was really the Corning Glass crowd. That was the hot stock back then. Dan, do you remember?
Oh, yeah, it was, wasn't it?
Right. Corning Glass. That was the big one. That's what everyone was coming for. But it's not that big anymore, but it was hot back then.
The hot thing.
Yeah. And after I left the floor, I stayed home with my kids for a few years, maybe close to a decade. And then when Tasty Trade started, Liz and I started a show over there. And I've been there since 2011. So it's been great.
Been fun. You didn't spend any time in Intel, did you?
No, I don't think. I briefly worked for Timber Hill, which is Interactive Brokers, and I bounced around when I worked for them. But once I started trading on my own, I just stayed in the Bristol Myers pit.
Okay, I thought we had someone with a similar name in the Intel crowd, but it's been a while.
I could have. I might have been in there. I might have been in Intel crowd briefly.
Yeah, it was a crazy time in that time. Yes, a lot of people coming and going.
Yeah, so it's so it's kind of nice coming on the show and getting to talk to you and Dan because I know I work with a lot of people from the trading floor, but Tom and Tony, those guys were mostly in the OEX. They're not the equity guys like we are.
All right, let's get the ball rolling. A little bit of the old options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to Options Drills, a portion of the show where we do just that. We take an options concept and expand on it in a little bit more detail and explain how you can utilize it in your own portfolios. And today's topic was prompted by a listener question Dan and I were discussing on the show last week. A listener right in, I believe the name was Conrad, asking about call skew in certain names. And it's a topic that's been broached by others recently. So it seems like it might be a good time to do a bit of a refresher on trading options and what we traditionally would call a high call skew or just maybe a high skew environment, depending on how you look at it out there. Now, we've talked about this in the past, did a lot of this back in 2021 when it seemed like everything was bid up to the upside and all anyone could do was buy out of the money upside calls. Not quite in that same environment right now. It's not quite as ubiquitous as it was in 2021, but there certainly are pockets of it out there. So definitely, I think, worth revisiting here on the show right now. Let's start. A lot of new listeners come into the show all the time. No idea what the heck we're talking about. Again, if you're not familiar with the terms like skew and others, go back into the archives. We touched on it many times. We spend a lot more time explaining it in more detail there. But quite simply, what we're talking about right now is a high call skew environment. What does that mean? Of course, you have the at-the-money call, which is traditionally your 50 delta call, right? And then, of course, you have your out-of-the-money calls. And the way skew is usually measured, there's different ways to do it, but most people tend to look at the 25 delta call and the 25 delta put. So that 25 delta call, the level of implied volatility, how does it stack up versus the at the money? And how does that compare, of course, to the historical levels that both of those have had? And that's what we're talking about when we're talking about a high call skew environment. Looking at that 25 delta call, that out of the money call, is it at a much higher level of implied volatility versus the at the money compared to what it has been in the past? And there's a lot of different ways you can analyze this. A lot of brokerage platforms will do this for you. A lot of great platforms, like, of course, we have Henry and Sibo and the folks at Trade Alert on our Option Block show. I use Trade Alert for a lot of this kind of scanning because they do a lot of great breaking down of the skew based on where they are as a percentile over the course of the past year. So a lot of platforms will do it for you in a lot of different ways. You can even configure some scans for a high out of the money call skew. So there's a lot of different ways you can look for this, but that's what we mean when we're talking about a high call skew environment. Let's go around the horn, get some thoughts before we dive into some specifics. Jenny, as our guest, we'll start with you. Obviously, everyone thinks of 2021 when they think of high call skew environments, but there's other pockets of it throughout time, including right now. So when I say to you, trading options in a high call skew environment, what springs to mind?
So, you have those stocks that have been having those crazy runs, NVIDIA, AMD, or you get those that are just on fire and everyone wants to jump on and be part of it. And those tend to have a call skew. I feel like those situations are really difficult to trade unless you're just selling naked calls, which is kind of scary in those situations. Because when you have such a call skew, call spreads trade cheap, so you don't want to sell them. And it's hard to sell puts when something's at towards its highest price. I prefer to find products that are at the lower end of the range and have a high call skew, and just sell puts in those products. Like right now, Tesla or Boeing or Disney, those seem to be lower end of the range, but they have a call skew, and I'll usually stay away from the calls, just sell puts. That's my preference, because I think it's hard to jump into those products that have been running up. Like, what do you do? What do you guys do in that situation?
It very much is. It's the opposite of catching a falling knife. It's catching an exploding bullet to the upside, right? How do you do that?
Yeah.
So a lot of challenges. Dan, same question for you, sir. When I ask you that, when I say the words high call skew environment, what leaps to mind for you, sir?
I kind of do this, Dan, somewhere between considering getting into buying calls, but, like you guys just said, that's really tough. But then I look for opportunities where it forms a resistance level and then sell some really, really short-term call credit spreads. And you got to be really careful doing that. There's got to be established resistance, not at an all-time high. You won't want to do that. And I will keep it very, very short-term because you're still kind of fighting the tape a little bit. So you don't want to have like a 2-week trade on, because that resistance can get broken pretty easily. But, like the high call volatility is an interesting opportunity.
It is indeed. So let's break down some ways you can take advantage of the opportunity. Again, obviously, there's a lot of different moving parts with this, and a lot of this is highly subjective, as Dan and Jenny just pointed out. But in general, when you're talking about a high call skew environment, one of the ways you typically want to take advantage of it is through strategies that allow you to sell that far out of the money call skew, allow you to capture some of that historically high ratio you're seeing between the far out of the money call and the at the money call. What are different ways you can do that? Some basic ways. Probably the easiest way most people are familiar with is, of course, your very basic covered call. Now, this would, of course, require you to have more faith in the underlying, because you have to hold the underlying in this environment. But if you do, let's say, already have the underlying, maybe in your back pocket, you're riding it up, and now you've decided, hey, there's a level here at which I don't mind getting out of this stock, and you see that you're getting a level of premium for a covered call on that strike, maybe somewhere in that out of the money call range, could be 5, 10, could be more, could be farther out of the money, depending on your preference. That's the nice thing about a high call skew. You could sell a farther out of the money covered call and still get a decent amount of premium for it. So you're giving yourself a lot more room to run on the upside. If you decide to clip it, to sell that covered call a little bit closer to the fire, then you're going to get a lot more juice for it as a result. So for covered call traders, this type of environment is fantastic. It really gives you a lot of juice to squeeze out there, which is great. And again, if you've already had a run, or if you have some faith in that underlying and you don't mind letting it go at this certain level, this is an ideal setup for you. The other way to go about it is, of course, if you don't want to buy the stock, but you like maybe a little bit more upside action to come from this name, and you like being able to take advantage of that at a discounted price. That's where things like long vertical spreads for calls can come in, right? You're buying the at the money. That's probably going to be a little bit inflated because vol is probably going to be up across the board in this name. But you're going to turn around and sell that out of the money call against it. And again, you're going to be able to buy that vertical for a much cheaper level than you would traditionally have been able to in the past, because that out of the money call is now much more expensive from an implied volatility perspective. So maybe that vertical would normally in that environment be trading for, let's say, $2, and maybe you could buy it now for $1.50, $1.25, something like that. So discounts on verticals. You can get in on action at a much lower outlay, dramatically reduce your risk, put on that position. That's also a very attractive way. Some people like to go the ratio vertical route of, buying one at the money, selling two. Dan and I have talked many times about being net short units to the upside, especially in a name like this. We've all seen GameStop and others explode to the upside, so we all know there is risk to the upside. So you probably don't want to go that route, naked net short units to the upside. If you're going to do that, you're probably better off going the debit or the long call fly route, so you have some protection to the upside. So of course, call fly listeners, you're going to buy something around the at the money vertical, maybe a little bit in the money, maybe slightly out of the money, depending on how you like to set up your flies, and then turn around and sell two of the farther out of the money calls. And now that's, of course, where you're going to start really taking advantage of that high call skew. And then because you don't want to get all of your account wiped out, you're going to buy another farther out of the money option against that. Now you're paying a little bit for that, obviously, farther out of the money option. So you're going to have to probably adjust, probably do a broken wing fly to really make them line up in the most judicious fashion. But those are just some very basic ways you could take advantage of it. Now, Jenny, you said this type of environment, you like to avoid it entirely and just go to the puts and put spread. So walk our listeners through some ways you like to approach this.
Okay, so I was caught in the GameStop run, and I learned my lesson. And I wasn't selling naked calls in GameStop, but I was selling naked calls in XRT, the retail ETF, which that ran up like crazy when GameStop was running up. So after being in that, and again, if you're selling a spread, if you think, well, I'm going to sell a call spread because I want to define my risk, well, those call spreads are just too cheap to sell. So unless, like Dan was saying, you go very short term and you're looking to capture your credit very quickly, I just do the flip side and take advantage of the high volatility, but we'll sell puts, but usually not on these products that are running up like crazy. I'll find products that have had a drop down, but they have a call skew, and I'll sell puts in those. Like right now, I'd be looking at Disney or Boeing or Tesla or products like that have fallen, but they have a call skew. I'll take advantage of that higher volatility and still sell puts. Kind of stay away from the naked calls. I don't know if Liz mentioned it, but we've both been burned on naked calls many times. We tend to stay away from them.
If there's one mantra we have on this show, it's avoid naked short units, especially to the upside, right? That's just,
right.
That was drilled into my head in my old market making days, and I never really got away from it. And obviously, if people needed a refresher, 2021 is about as good as one as any in terms of just,
right.
You weren't even short GameStop. You still can get your face ripped off in just adjacent names. So yes, the risk is there. Mr. Dan, same question for you. You brought up an interesting suggestion. You brought up the short call vertical or the credit call vertical, which is actually one of the ones I have on my do not trade list in this environment, because for the reason Jenny just said, usually you're selling them for a pittance, for not much at all, because that out of the money call is so big. So why do you like short call verticals in this environment, and how else do you like to approach the high call skew environment, sir?
Yeah, and it depends on a few scenarios too. I mean, if you're selling an at the money call and then buying a higher volatility out of the money call, I'm not necessarily a big fan of that. But when you get, typically what you get is the volatility sneer, where the volatility goes just a teeny bit lower with each successfully higher call strike. But when I'm thinking about a lot of these stocks that the volatility gets bid in the calls, I think where the volatility just gets a teeny bit successively higher with each higher strike. So not getting into that, negative volatility skew very much. I definitely would avoid that. But the only time I like it is if the volatilities aren't that disparate between the two, and I can just get an overall bigger credit than I otherwise wanted to, otherwise would have gotten. And, like I said, I definitely always keep them very short term because you're fighting the tape. You're just trying to steal a little money out of there by having a trade on for a couple of days.
All right, let's look at the flip side of that really quickly, and then we'll get to obviously some of your questions as well. Obviously, in a high call skew environment, there are things you want to avoid, and it's effectively everything that's the flip side of what we were just talking about. We were just talking about strategies that take advantage of selling that far out of the money call, taking advantage of that high call skew. Anything that makes you pay up to get it, you probably want to avoid. Obviously, we talked about covered calls. The flip side of that would just be straight buying a far out of the money call. Probably want to avoid that in this environment. Also, what Dan was just talking about, I mean, outside of maybe some very, very quick short-term scenarios, you definitely want to stay away from the credit call spreads, the credit call verticals, selling the at-the-money or somewhere around the at-the-money volatility and buying farther out of the money vol, because, again, now you're selling that call spread, as Jenny pointed out, for a very low level. It's not really worth doing. So stay away from those in general. Any sort of ratio spreads that involve selling near at the money and buying farther out of the money on a ratio, you want to avoid that. So the reverse ratio is what we were just talking about. Credit call flies, where you're selling at the money vol, then buying too farther out of the money vol. You probably want to avoid those in that scenario as well, unless you can really break the wings and really structure it so that you're selling at the money, buying too out of the money, and selling some even further out of the money. And somehow, because the call skew is so wonky, maybe that further out of the money call will help pay for everything. But outside of that aberrant scenario, you probably want to avoid those kind of credit call flies as well. Jenny, any final thoughts on do's and don'ts or just takeaways for our listeners if they encounter a name with a high call skew?
Well, we get questions all the time on some of these products, because many people see if they've had such a run up, and these are usually the products with these big call skews, they'll want to fade the move. And so we'll suggest, maybe looking at buying a put diagonal or doing something like that to, if you're bearish and you're wanting to fade the move, instead of using those calls, use the puts and maybe buy a longer term, like an April 50 delta put and sell shorter term March 25 delta put and put on some kind of long put diagonal if you're trying to fade this run up the stock's having. That might be a better way than instead of using those calls.
There you go, Mr. Dan, the final word to you, sir. What should people take away when they're thinking about trading options in a high call skew environment, sir?
Well, it kind of goes back to fundamentals, I think. Whenever you're trading options, you're trading volatility. And the way I look at it, and I think the way a lot of market makers would look at it, is the at-the-money volatility is like the volatility, and then the skew is skewed, right? So when we're looking for opportunities, whether to buy or sell options, we need to pay attention to whether volatility is cheap or expensive. And it's abnormal in most stocks, it's abnormal for the calls to have a higher implied volatility than the at the money. So I think it's just important to remain open-minded. If you're doing covered calls, that could be a gift for you. And just consider, hey, what do I do with this overpriced volatility? And you just start asking yourself that question, and that's going to help guide whatever strategies that you would otherwise trade and construct them in a smarter way for that overpriced call scenario.
Remaining open-minded. Good advice for options trading. Also good advice for us as we head on into the mail call.
Mail call. Time to look at questions submitted by our listeners.
So festive here on Options Bootcamp. It's always Flag Day. It's always 4th of July, even in the depths of winter here in Chicago, whenever we do the show. It's always fun. And Jenny, they didn't prepare you, so I won't make you come with a question of the week for our audience. We'll save that for another time. Instead, I'll make Dan do the heavy lifting this week. Mr. Dan, the folks are waiting with bated breath. What is your market taker question of the week?
Well, you know what? This is actually a really funny coincidence because I was asked a question in our chat room like Monday or something. And the question, Jenny, you're going to love this. The question was, somebody was talking about a zebra spread. And
that's what we had. That guy just asked us that. on the show. Remember, he wrote in.
That was on the show.
He wrote in with the zebra. Yeah, that was his suggestion. And we had no idea what the hell he was talking about. Yes.
I knew somebody asked me recently. Okay, yeah, so it's on the show last week. And I was like, I don't know. And then I was in my chat room, and one of my my good student traders was like, "Oh, that's from the Liz and Jenny show." And I was like, "Oh my God, that's hilarious. I'm going to talk to her next week." So I think I can bounce the question to Jenny if that's cool.
Oh, so Jenny, you guys have another animal named spread that we're not aware of here.
Okay,
I mean,
so
when Liz was on last time, she walked us through the jade lizard. Dan and I weren't really familiar with it. As he mentioned, we had a listener reach out to us last week mentioning the zebra. We had no idea what the heck he was talking about. So I'm glad you're here to set us straight.
I do want to say, we did not come up with these ridiculous names. So when we created the jade lizard strategy, my name is Jenny. Her name is Liz. We put it in our viewers' hands. We said, you name it, we'll put it on Twitter, and the winner, we'll announce the winner. So someone was combining J and L, and they came up with the jade lizard. That was the winning name. So it's not our fault. And the zebra that got its name because it's a zero extrinsic back ratio. And so when you put it, you just zero extrinsic back ratio, it ends up almost spelling out zebra. Oh. That just became the way we would refer to it. And I know it sounds insane, but it's just quite simply it just replicates 100 shares of stock using options and having no theta. So you have no theta decay. You're not giving up any extrinsic value. So you buy 270 delta. If you want to replicate 100 long shares of stock, you use the calls. And you buy 270 delta calls and sell 150 delta call. So you're getting 90 deltas, but you're completely washing extrinsic value. And then on the put side, you do the opposite. If you want to have 100 short shares of stock, you would buy 270 delta puts and sell 150 delta put. It would give you 90 short deltas. So it acts like stock, but it's much, much less capital, and it will make money one for one, but your risk is capped. You don't have the unlimited risk.
Interesting. So now I know the next time someone sends us in a weird anthropomorphic spread name, I'll know to go to you guys first. Oh, it must be another. This is the crazy hippo.
If you plug it in and look at the analysis, it is just a back ratio. That's why we call it the zero extrinsic back ratio.
I like it. Oh, there you go, Dan. See, Jan, we were just joking about this last week. See, everything comes full circle here. We were joking about jade lizard before that, and then Liz came on. And she taught it to all of our listeners, and then just randomly we get the zebra, and now here we are. The options world is very fickle at the end of the day. I like it. All right, so good one, Mr. Dan. I like that. All right, let's keep on rolling. Let's go out to some of our own questions, our poll questions you guys always tackle here, our listener questions of the week. We had a couple of fun ones last week. We did a quick flash poll during, I believe it was our Option Block show last week, because we were debating this on the show. We asked you quite simply, what do you think is leading the dance in the market right now? Gave you three in the infamous other: the Fed, earnings, election vol, or other. And exactly half of you, 50%, said it was the Fed. 40% going for earnings. Only 10% saying election. No chime-ins for other. I usually that's how we got the zebra last week. Someone wrote in for other. So I always love and look forward to the others because you folks always write in cool stuff. But no others on that one. Our actual question of the week last week was, along the lines of volatility. We said, hey, VIX has been sub 15 for most of the time since last November. And if that continues going forward, how will that level of vol impact your options trading? We gave you a bunch of different choices. You're saying you're going to do less credit or income trades. You're going to flip it around. You're going to buy more. You're going to do more debit long premium trades. Other, something else you want to write in that's funky. Or you have no impact or immune to VIX. I think that's where someone wrote in the zebra on this one. And what ended up taking it was 35% of you saying it has no impact or you're just immune to VIX. So you don't really care where the vol level is. And a lot of you wrote in saying you trade a lot of high contango type strategies using a lot of these vol ETPs. So the relative level of vol doesn't matter as much as the overall shape of the futures curve, the contango. So that makes some sense. That is a scenario. I wouldn't say it's immune to VIX, but it's not quite as dependent on it. And then 30% of you saying you're going to buy more premium, more debit long premium. 20% saying you're going to go the other way, sell less. less credit or income trades, and then 15% went with the infamous other. All right, fast forward to this week. Our live question of the week right now, listeners, you guys can play along as always at Options over there on the Twitter. And we said our earnings season going strong right now. Big reports coming out from Microsoft, Apple, Meta, and Amazon last week, and more are coming out to move markets and drive volatility, which raises the question, how important is earnings season to your options trading? Very important, somewhat important, a little, I guess, or not at all. Mr. Dan, we'll start with you, sir. If you have any thoughts on what else our audience voted on, I think the Fed is driving the market. A lot of them, 35%, say they don't care where the hell VIX is for their options trading. And then B, what do you think they're voting for right now in terms of how important earnings season is to their options trading?
Oh, well, I mean, as far as me, I say it's very important. And I say that because, like, I put out this daily video, and a couple days ago, the video was the market is watching the wrong thing. Everybody's focused on the Fed, but it turns out almost not mattering, because when we get bad news, the market goes up. And when we get good news, the market goes up. And like, we already know what the path of the Fed is, but some people sort of try to get ahead of it and be overly optimistic. But what really ends up mattering is earnings, is like the PE ratio of stocks and or the market itself, especially the market itself, I would say. And when earnings are better than they were last quarter, like they are this quarter, that raises the P in the PE ratio, or no, that raises the E in the PE ratio. And so what that ends up meaning is that the PE ratio ends up being smaller, and there's more room for the stocks to run up. So I know that's a very long-winded answer, but the answer is very important, because when we're selecting which strategies to trade, we need to know what the implied volatility is.
So you're going to say very important. You think our audience is there as well?
I think they're going to go somewhat important.
All right. Oh, there you go. Interesting. All right, Jenny, same question for you. If you have thoughts on these other polls I laid down about our audience saying they're immune to VIX and thinking the Fed is leading the dance, have at it. And then coming into this week, our actual question of the week this week, we're asking our audience, how important is earnings season to their options trading? If you have your own vote, have at it. And then B, more importantly, where do you think our audience is falling?
So I think the audience is going to say somewhat important, and I think I would say the same. I mean, we have had some mixed earnings, but we wouldn't be at the levels we're at without some of the big ones, right? Like NASDAQ, NVIDIA, a lot of those really drove up the NASDAQ. And so, we're at levels we haven't seen before, but now that the earnings are over, is it going to settle down? I think so, but with this low VIX, what do you do? It was interesting to hear some of the people didn't really care about the low VIX and they were going to just trade anyway. For me, I try to, still find products that have a higher vol, or search for my, like, trading universe is smaller when the VIX is so low. I'm looking for things that do have high vol to trade. I'm not just like blindly trading anything, because if it has a low vol, I'd rather not trade it. But there are some great questions. And I think earnings have been tough for some people because we have had some outlier moves. And so a lot of our viewers have said, I've had it with earnings. We've had too many outlier moves. I'm not going to do them anymore. But they have affected the market and the up move we've had. So it does affect the market. I think the viewers will say somewhat important. I don't know how many of your viewers are active earnings traders.
Yeah, let's get into it. Obviously, it's hard sometimes to get caught on the wrong end of an 80 handle move in Meta. That could leave a mark. So I could see why some of your listeners would not be a fan. We tend to mostly counsel on avoiding it whenever possible, but sometimes it's unavoidable. You want to trade around. I know Dan does a lot of, obviously earnings trading with a lot of his systems. So it is very subjective. I know for a lot of our listeners, they tend to mostly trade around it. And looks like that's backed up by the data here. Right now, 58.3% saying it's somewhat important to you right now. So it's not the biggest driver, but it's something you pay attention to. Obviously, you can't ignore it. If you're trading a product and it has earnings popping off after the bell, you need to be cognizant of that. So 58.3, that's probably maybe a little higher than I thought, but I thought somewhat important would be taking it. Then we have pretty much a tie for number 2 between very important and a little, I guess, with both around 17%. And then a little over 8% saying not at all. You got a couple days left. That is our question of the week. So that will obviously expire at the end of the week. Get over there at Options. Make your voice heard out there. Listen, let's keep rolling. Let's go out to this question here from JJL. Sent it in last week. Didn't have a chance to get to it on the show. He says, should I apply the lesson about not selling covered calls from your great covered call debate episode to short puts as well, since they are the same thing? Interesting question. Before we get there, Jenny, I'm curious for your take on covered calls right now in general. We've been talking about them on our show of late. In fact, we had a good episode a few months back where Dan and one of our other guests, Mr. Matthew Moratz, were in a heated debate, locking horns over whether it was a good time to do covered calls now or not so much. Dan was on the pro side, Matt was on the con side. And I'm curious, before we even answer the question, where do you fall right now on covered calls? Are you a fan? Are you not a fan? You find you're doing them less than maybe you were in the past? Or what are your thoughts?
So I don't, honestly, right now I have no covered calls on, and I probably have 60 positions at least, but no covered calls. But, on the flip side of that, I have plenty of at the money puts, which, you can look at it as a synthetic covered call if it were slightly in the money put. But just for capital purposes, I trade on margin, puts use way less margin than a stock position. But as far as getting into a bullish position now, I'm careful at what I select. Like, I'm always looking for lower price products or products at the bottom of the range, something that has a higher vol. And so I have a handful of products that I have my bullish positions on, but it's not just anything, and it's nothing that's near the top of its range.
So it sounds like you are okay with some short puts in this environment, even though you're kind of keeping your powder dry on the upside, on the covered call side, Jenny. Is that a fair assessment?
Right. So lots of people like to have stock and keep their stock and keep selling calls against them because they don't want to lose their stock. I understand that. But when you start out as a trader and you come from the trading floor and you just are an options trader, there's a lot more capital efficient to just trade options.
When those puts get put to you, do you turn around and wheel out of the stock? What is your next step after that? I'm curious.
So we call that the wheel of fortune. If we're selling puts and we end up getting put the stock, then I'll usually just keep selling calls against that until at some point it runs through the calls and gets taken away. Because at some point, if it runs through the calls and there's nothing left in the calls, I'm never going to pay to roll my call out and up. I'll never pay to roll a call. Like, if it gets to the point where I have to pay to roll my call to move it up, I'll just close the position.
I recall Liz was a fan of the wheel. We had a long talk about the wheel, I believe.
The wheel.
When she was on. Yeah. Many different names. You guys call it the Wheel of Fortune. We called it the Wheel of Fun, Wheel of Death, all kinds of fun. Triple income strategy, one of our hosts calls, which I hate, but he loves it. So it has many different names, the wheel.
And some people like to hold their stock. They like to get their dividends, and they don't want the tax repercussions of selling the stock. So I get it. There are plenty of people who have stock. They sell their calls against it. And if you're already in that and you don't want to sell it, sure, keep selling calls against it.
Mr. Dan, sir, same question for you from our buddy here, JJL. You were obviously on the pro covered call side, so I'm going to assume you're also okay with selling puts in this environment, or what do you have to say here for our buddy who wants to know, should he be selling puts right now?
Yeah, I am okay selling puts selectively, of course. And if you recall, Matt, who was on the anti-covered call side, he did just kind of slip in there that he did a back test, which was selling at the money puts. Wait, how did it go? Selling at the money calls against a stock you own, and if you get assigned and lose the stock, then you sell 30 delta put or something. He had a put strategy that he said, a put selling strategy that he said was outperforming the market. I forgot exactly what it was. I thought it had something to do with it.
I didn't hear it because he was too busy hurling invective at you the entire time, that intense debate. I was just trying to hold him back, virtually, of course.
So, yeah, I mean, in a lot of ways, it's a challenging, I mean, in general, in a lot of ways, it's a challenging environment for covered calls and cash cured puts. But like Jenny pointed out, like, you know, if you pick your spots and you do it on the right products, you do it on the ones that, you know, maybe are not at an all-time high and that maybe do have a little bit of overpriced volatility to it. Yeah, I mean, I'm definitely not ruling out covered calls and cash cured puts.
All right, that music means we're coming up against it here. Let's get a little bit of listener love more on the way out. We have I was just joking about this. Looks like our pro members agree. We have one of our pro members, Age of Del Aquarius, listening and saying, after all this talk of zebras and jade lizards, he says, pretty soon I'll need a degree in zoology to trade options. So there you go. There you go, Jenny. You're luring all of our listeners to the dark side of anthropomorphic option spreads. So there we go. We got a little bit more listener love here. It comes from, I like his handle, BTC Vix. Even though that wasn't always his handle, he wrote in about a month and change ago. He said, Mark, when can I get an OG follow from you for being the first person to talk about Bitcoin futures and options back in the 2013 mailbag section? He said he wrote in as Bitcoin Bravo then. And yes, I vaguely recall that. 2013, you were definitely ahead of the game. So yeah, you get a follow for that. We don't follow many people out there because a lot of noise on Twitter, obviously. But you know what? Mr. BTC Vix, a.k.a. Bitcoin Bravo, for being so well-timed on the crypto questions front. Being ahead of the game, you get a follow out there. He was excited. He wrote in saying, I finally followed by Ad Options, a true legend in the space, and boy, did he know how to choose the right handle back in 2007. Yeah, we had a little bit of good fortune on the Twitter side. If truth be told, I was just lazy. I didn't want to write Options Insider every time, so I just grabbed Ad Options. If I knew how much of a land grab Twitter would become, I would have grabbed everything. I would have grabbed CME. I would have grabbed NASDAQ. I would have grabbed Schwab. I would have been the biggest Twitter squatter on the planet, but I was just being lazy. It turned out to work out. We have a pretty fun handle over there at Options, and we're happy to follow our listeners who've been listening for a long time, sending in so many great questions, and obviously, we're quite ahead of the curve. Congratulations to you there, Bitcoin Vix. But that's going to do it for this episode. Jenny, great job in the guest chair. Before we go, if there's any other thoughts you want to leave our audience with, now is the time. The floor is yours.
I will say one of my favorite things to do, and it violates some of our rules that we have over at Tasty, but I do like finding products that I'm interested in or wouldn't mind owning and just selling weekly puts until then you get put the stock and then turn it into your covered call. So that did well for me last year, and I am doing that in a handful of products this year. So that's my trading tip of the day.
There we go. And if people want to check you out at your day job, where should they go? What should they do?
I am on live every Monday through Friday, 10 to 11 Central Time at tastylive.com. tastylive.com. It's free and it's fun. We have a nice community of people. I'm also on the road. We're on tour this year. I'm going to be in Houston in a few weeks. So you can check our tour out at tastylive.com/events. And we're going to be all over the place this year.
There you go. Check them out on tour. And Dan, if they want to go on tour all the way to the Southern Options Mecca of Frankfurt, what can they find when they get there, sir?
Yeah, you'll find MTM World Headquarters here in Frankfurt. But I'll tell you what, you don't have to make the trek all the way here. You can find us on the interwebs. Just go to markettaker.com and join us. Click the join free button. We've got some free classes and such. You can join our chat room for free, and we'd love to hear from you.
It is funny. All the Frankfurt invading Options Bootcamp this week. It truly is the Southern Options Mecca. And there's a chance we all cross paths on the SIBO back in the. How weird. The options world, very incestuous at the end of the day. That is going to do it for us on Options Bootcamp. Also going to do it for us on the network today. Back again tomorrow, listeners, with your double dose of the option block with our friends over there at SIBO and the Flow Master joining us for a lot of great data and analysis and what's trading. Then after that, for a whole bunch of futures options with our friends over there at CME this week in futures options. So stay tuned for that. Friday, of course, back to talk a whole bunch of on volatility views. Who will be our guest? Got to tune in to find out. It's been a great guest roster already, and the year's just getting started. And then after that, exclusively for our pro folks, we come back for a whole bunch of options oddities. We get weird, we get wild, we uncover some crazy trades out there. So check that out. If you want to check that out for yourselves, only one place to go, theoptionsinsider.com/pro is a place to get access to all that fun and a whole bunch more. Then we're back again next week, all the way through to next Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.